I need to understand their challenges. What do you need help with? What do you think the problem is? And what is your biggest business challenge? And then I put together a list of discovery questions so that I could find out a lot more about what's going on in their particular business, so you don't run into any surprises down the road. You have to figure out what they really need, first of all. And then you have to explain to them how your services or the guidance you're going to provide to them is going to solve their challenges. And typically, what people like me want to know is, well, how is this going to benefit me financially? So you have to build that out for them as well.
Hello and welcome to the Gross Profit Podcast. My name is James Kennedy. I'm the co-founder and CEO at procurementexpress.com. We take the hassle out of managing your company's purchasing with magical features, but we're not here to talk about that today. Instead, rather selfishly, I've invited someone along to help me with a business challenge that we're looking to roll out in the company, and I thought you might benefit from the conversation. We are a company with a background in products, so that is to say that we build our software, we sell it for a fixed price or a subscription normally to our customers, and that's why we've grown the business. But we've decided to do something different, which is focus more on the expertise of our customers and start to build out a professional services wing. The aim here is twofold. One is to help to develop more complex integrations and products for our bigger customers, but also to be able to build new products for our existing customers who are interested in building new tools that would help them day to day. Over the years, we've built many pieces of software which absolutely nobody uses, and we've decided we're actually, to be honest, idiotic when it comes to trying to guess what our finance teams and SMBs really want. So instead, we're flipping the script and we're starting to offer our time. Let the experts tell us what they need. We'll go ahead and build it. So with that in mind, I have invited along today Justine Lemanowicz from Fit2Grow CFO.com. That's with the numeral 2 in the middle of it, Fit2Grow CFO.com. And I have asked Justine to come along because her particular expertise in helping to build out professional services companies and teams that build by the hour instead of by the product. So, Justine, thanks very much for coming along today. Maybe you could just give us a bit more background on what you've done to date and where you are in the world so the listeners can get to know you.
This is a conversation that I'm very passionate about. It's what I know. It's what I enjoy doing and helping companies increase their profitability and setting them up with success. So my company is Fit2Grow CFO Solutions. I'm a fractional CFO, and what that means is I plug into different companies on a part-time basis who might need somebody with a higher level skill set, some strategic guidance, and I also work on projects for companies like this for professional services firms. So typically when I get engaged with a client, they have a problem. It's either cash flow, bottom line, they're not really sure what's going on in their business and they need some guidance and somebody who can come in and figure out, what's going on and how could they improve their performance.
So our problem is that we, over the years, have, like I said, we've spent hundreds of thousands of dollars sometimes trying to build a feature within our product that actually no one really uses. We've maybe talked to customers, say, oh yeah, an RFQ product would be great. And we sort of build one and then we put it out there and then nothing happens. And we are in a situation where we've never had a timesheet. We've never tried to, really, maybe we should have. Now that I'm saying it out loud, sounds a little bit crazy. But we have great engineers who know and familiar with solving problems for SMB finance teams. So if we wanted to think about how to grow this professional services team within the business, what structure in terms of the profit loss statement, for example, or other building blocks do we need to put in place to get started to actually be able to pull a profit at the end of it?
So I think one of the first steps you need to address in what you said is, you spend time building a product and maybe your client doesn't use it. So my process is when I walk into a client, I need to understand their challenges. What do you need help with? What do you think the problem is? and what is your biggest business challenge. And then I put together a list of discovery questions so that I could find out a lot more about what's going on in their particular business. And so you don't run into any surprises down the road. You have to figure out what they really need, first of all. And then you have to explain to them how your services or the guidance you're going to provide to them is going to solve their challenges. And typically, what people like me want to know is, well, how is this going to benefit me financially? So you have to build that out for them as well. Okay, so my services cost, $12,500. What are you going to get? And how long is it going to take you to realize your return on investment? So your CFO, your controller, and the CEO of the business, those are your decision makers, and they want to see numbers, right? What can you do? What does it look like current state? And if you follow this process, what will it look like futuristically?
So let's start with the beginning there, which is that I've read a book called Ready, Fire, Aim, which I really, really like. It's a book which describes how to grow your business. Once you get on, say, the first 10 million in revenue, there's these little sort of stumbling blocks that companies get to. They never get above a million, then they maybe get to 5, then they maybe get to 10, and they can never get beyond that. So you get to one of these ceilings. I'm not going to exactly talk about which one we're at. And you seem like, wow, we just can't get beyond here. And in the book, the first thing they recommend doing is you set up this kind of a separate group, like we're trying to do here for professional services, with a separate P&L. So it's separately responsible and it has to live and die by itself. It can't live off the mothership's success, if you like. So if we're to do this for our professional services, like how would the P&L look differently from our SaaS P&L, for example? Or what do you think is really important to set up as a baseline in a professional services organization?
How I would approach this, unless you're setting up a completely separate entity, it depends on what accounting system you're using. But you can typically set that up so that you could report collectively on the entire business and use maybe classes or departments and tag those transactions.
Right.
And that's what I recommend. So typically companies, and like you just said, they'll start out with one revenue line. Okay, this is what we do. And then once they start to expand their services, if they don't break those out by line of business, the more they grow, the less they're going to understand what's going on in the business. So my first suggestion in building out financials is exactly that. Let's start with revenue. You should have a separate revenue bucket for each line of business. And then your cost to serve, or your cost of goods sold, you should also align those employees or products or tools that you need to fulfill, revenue. You should also align those with those different lines of business. So if you have, engineers building a SaaS product, you should have a cost with that. If you have somebody building web applications, there should be a department for that.
All right, so I got that. I'm going to set that up. I'm going to set up the new items in the GL, and I'm going to tag them with classes. And then we've got in here to talk about, cash versus accrual basis. I mean, all businesses, am I wrong, are using accrual basis over a certain turnover. And what are the pitfalls? You're smiling. You're thinking, no, oh my God, what's going on out there? But what are the pitfalls in trying to go full accrual or full cash?
If you think about on a cash basis, let's take consulting firms. Unless you're strictly billing on time and materials, hour for hour. So you're billing 1 hour of revenue and you have 1 hour of cost associated with that revenue. You may be at a point, which I would probably recommend, initially starting out at T&M and then moving to more of a retainer or a fixed price project, or maybe quarterly payments, because you can price your projects in a manner where it's not completely transparent to the client, but if you're really good at budgeting your hours, how long does it take to deliver this type of project? You could push the project forward much faster. You're earning the revenue and working less hours. So you always want to pad a fixed price because I would say for the majority of time, there will always be unknowns that pop up. That being said, you need to make sure you structure your statement of work and make sure that you identify exactly what's in scope and what's not in scope, as well as the assumptions. I assume your team will provide me timely data, and here's the data that I'm going to need. Here's what we're responsible for. Here's what your team's responsible for. And these items are out of scope and will be billed at X amount or will require a change order so that they really know what to expect and there's no surprises at the end. And companies typically, larger firms especially, they like the fixed price model because they know exactly how much it's going to cost them. Companies who are working on time and materials, they might have the perception that, hey, they're going to bill us as many hours as they possibly can.
Well, I guess if you've done lots of these projects, right? So if you're familiar with them, and software projects, I know, are notorious for going out of scope and over time. If I'm not wrong, even 50% of ERP implementations go over scope and out of time. And that's just an ERP implementation, never mind actually custom software development. So you're recommending it is better to have a fixed price. I guess that's easier to sell. You do get a cost plus model in some industries, which they go for, because cost plus inherently leads to bloat, right? Because you're incentivized to bill more hours, not deliver more value.
Mm-hmm.
And what you're saying is if you can get it down to reasonable confidence in terms of how long it's going to take to deliver something, then you're actually incentivized to get the work done quicker, hopefully with the same quality. And we'll get onto incentives and motivating that later on. So I think I understand there. We mentioned a little bit before the call, like how you've gone into some places where they say they're on an accrual basis, but it's not always truly the case. Why is this so challenging when it seems like kind of a straightforward nuts and bolts accounting 101 thing to do? In practice, why is it so hard to get this fully right? And what are the excuses you hear against running accrual-based accounts?
Well, typically when a company starts out, they may have a bookkeeper who doesn't fully understand accrual accounting and cash accounting. So cash accounting is the easiest concept to understand. When companies grow to a certain size, and especially when they're using some type of retainer or a fixed price, what you'll see, if they're not using accrual, their month-to-month profit and loss statement is going to mirror that of a roller coaster, which is a lot of peaks and valleys. So let's, just take the example of I have a $125,000 project, and in my agreement, I'm going to bill half of that up front. Okay, so I bill that today, which is the 15th of May. Then the project, I don't have resources ready to start on that project until June 15th. So at the end of the May, when your controller or CFO is closing the month, you've earned 0% of that revenue. So you need to basically make an entry to decrease that revenue, and then that goes on your balance sheet as deferred revenue. Let's say next month you complete, 25% of that work. So then you're looking at what have we invoiced? What do we have in deferred revenue? What have we earned? And then adjust accordingly.
So I like that because it aligns the operations team and here's a big one, the sales team in the same way, right? So the sales team typically will sell a project in, they'll get their commission check, they're off on a yacht somewhere drinking champagne, they don't really, whatever. So how do you handle that with the sales team? Like, do you tie their commission to the actual revenue rather than to the cash in the door as well? Or that would seem like a tough challenge to achieve, or do you think you can do that?
I would definitely tie it to cash collected.
So you let the sales team away with it, kind of. You say, okay, which is fair. I get it. Like the sales team work very hard. They've been working 6 or 12 months on bringing a deal in. They get it over the line. They have done their job. So aside from that, we take that cost up front in the month that they win the deal. And then on the revenue side, it's up to us as business owners to be honest about when we're really earning the rest of the deal that came in. So we were straight away splitting out the sales comp versus the operations side here. So that's the first thing I got to take out of this. So that's another line in the P&L, I guess. I got to treat that separately. And I mean, what you're hitting on there is exactly the problem service businesses have, which is complaint about fluctuation. It's a feast or a famine. They have either too much work or too little work, and they can't seem to get the balance right. And what you're saying there is oftentimes they have the balance right, they just are not accounting for it correctly because they're just looking at the bank account every month.
Correct. There's some accounting systems out there, they're pretty expensive though, that will handle revenue recognition the right way. It's based on budgeted hours and what's actually been consumed on the project. You have to look at that and then look at the percentage complete. Otherwise, you're working on, a spreadsheet, and it's doable if you set it up right. You just have to make sure to communicate with your operations team, validate that this is where the project's at. If they ran into an issue, and an issue could be we didn't scope the project right, there were unknowns we should have known about that were in the statement of work, but we didn't account those in the budget hours. Or you have a resource that completely trips up, and maybe he didn't have the skill set to deliver the project. So now you either have to make a change and remove him from the project, but he's already consumed hours, so you got to add those hours on. So now that might even change, how much revenue is being recognized, because now you just added hours to your budget. So it is a little bit tricky.
Yeah, well, it's very tricky, let's face it. So would you surface that to the operations team? Let's say there's an account manager managing that project. Would you KPI that account manager based on the revenue recognized?
It's really about communication. Your CFO and controller, they should have a month-end process. They should communicate that to basically everybody. You have to track your time. You have to track your time on the project. Your directors and managers have to hold your team accountable to tracking that correctly. And then maybe your leadership team of operations, you'll hand them the report, you're tracking it, they're tracking it somewhere, whether it's in a system or it's a project management software or offline in a spreadsheet, hopefully not, but they have to go through and validate that the budgeted hours versus the actual hours are correct.
Okay.
And we'll get into compensation a little bit more, but there's motivation for them to also make sure that's accurate.
It is strange to me. I know in the SMB sector, you have QuickBooks and Xero, etc. But it seems like such a major part of any functioning system to be able to recognize that revenue properly. And we see that in our business. We have a giant spreadsheet. And, any spreadsheet with more than 100 rows becomes a mess. That's it. And now it's just such a stressful point because you never really believe the spreadsheet, no matter who has control over it, you're always wondering. And especially the finance team can be so far from the operations team. Mm-hmm. Sometimes you feel like the accounting team is sort of reading the tea leaves. They're seeing payments coming in. They're kind of sometimes guesstimating what it's all about. Was this sales commission is whatever. And the lack of communication there keeps me up at night. But you said something there, which is at the one hand, solution, you should be doing this. On the other hand, you're saying, do it in a spreadsheet. On the other hand, you're saying, well, don't do it in a spreadsheet. So when you go in with a client, how do you solve this? Do you tell them to buy like 100 grand's worth of software to fix it? Is that the only way? Or do you have the spreadsheet they can use? Where's the middle ground?
So I think it depends on the size of the company.
Right.
Smaller firms, maybe they don't have 100 projects and they're not going to be able to justify, implementing a system, an Oracle or, like a NetSuite. That costs a lot of money. QuickBooks is relatively inexpensive. Let's just say also you have a project management tool, you have a timekeeping system, and then you have an accounting system, right? So your project management tool, that's where you have your budgeted actual hours. Your timekeeping system is where your employees book their time. And then you have the accounting system that's supposed to tie everything together. So I'm not sure how much you know about data analytics tools, but they're pretty cool.
Now you're speaking my language. Now we're getting nerdy. I like it.
All right. As long as you have, as you know, a key field that ties in all this information together, and you have somebody on staff who's able to build out the model, that will really help you run your business and tie everything together. So there could be some pretty complicated calculations, and you may need somebody who is a data analyst and understands, for example, Power BI DAX functions. It's easy to learn, but some of the more complicated calculations, you might have to pull in an expert.
But then keeping the data clean seems like garbage in, garbage out. That seems like a big challenge. I guess that's what you're saying here. Like if you want to be able to pull from your timesheeting solution you got to believe in that timesheeting. You got to believe people are using it.
Mm-hmm.
And then the project management for completion rates, I guess. You got to believe people are using that properly. And then there's a lot of ways that it can fall. And then you just got to believe someone's copying and pasting correctly. I mean, that's another one. So it's tricky. I can see why it's very nuanced. So you've talked there a bit about the different types of software you need. You're saying that we need an analyst to tie them together, potentially. Is that the sort of resource you can bring to the table? Or would you help with the recruitment process in that?
So I want to back up a little bit about something you said.
Sure.
Where there's communication gaps between operations and finance and sales. So it's really a matter of getting everybody in the same room and explaining and making sure their goals are in alignment with the company's goals and understanding why. And not only is it, people are competitive. We like to win. Here's where we're at. Here's where we want to be. Not only that, but compensation should be baked into these, let's call them, holding people accountable. This is what you need to do because this is what we need to run our business. If this is inaccurate and you're not managing it, then our financials are going to be inaccurate. And we might come in, our margin might be a little bit lower. And if we're rewarding employees based on those metrics, they're going to be wrong. And either we're going to pay out too much or we're not going to pay out enough. And if your compensation, your bonus incentives are also based on that, you have motivation to make sure that's right too. And your CFO or controller owns all that. They make sure that the time sheets are completed, they're approved. They make sure that the project hours are up to date. Your operations team has to make sure that they're accurate. So it's just, instead of finance and accounting sitting in some silo, it's collaboration and communication and making sure we're all working together as a team to accomplish what we need to do.
Yeah, I mean, this is a big area of the difference between accounting and CFO, right? It's the actually operationalizing the information and treating the accounting as the heartbeat of the business, really driving the business as opposed to just something to pay your taxes and stay out of jail. You're touching there on incentives. So tell me about how do you go about setting those incentives up in the correct way? Because if you get incentives wrong, they can go horribly wrong, right? So, because, sales, I guess, is straightforward. Commission, we're all familiar with that. You need to get down into the overhead costs or into project costs. What's your approach to laying out those incentives in a way that's going to drive the behaviors you want?
So first of all, structuring your financial statements in the proper way, revenue, cost to serve, sales and marketing, and G&A is key. Using accrual accounting is also important because it's going to smooth out and allow you to see trends, right? Using revenue recognition. So your margins should be relatively consistent. And I'm going to talk about utilization too and how that factors into the equation. What I see companies do is, you start with a very small chart of accounts. But as time goes on, your business gets a little bit more complicated. There's more costs. You're adding more people. You have to make that decision. Okay, we need to make this change. We're not small anymore. We need to set ourselves up for the future because when we look down the road, here's where we were last year or last quarter, and here's where we are this quarter. Are we on track for our budget? And then that'll allow you to say, okay, here's our baseline with gross margin. And so let's just say it's 30% or something, and we want to move to 40%. So how do we get there? Well, you're using RevRec rules. So you're recognizing revenue accordingly. You have your costs, and most of your employees are going to be salaries who are delivering on these projects. One mistake companies make that I see is they don't use loaded costs. They just look at, okay, here's your salary, divide it by 2,080 hours, which are the number of 52 times 8 hours per week. And okay, there's their hourly rate. Well, that's not necessarily true. You have employees taking paid time off. there's training and development, there's internal meetings, there's conferences they need to attend. So you also have to track internal time. And when you see that a resource is only consistently 60% utilized, you've got a lot of money on the table there. You know, they might be on the bench waiting for a project. They might have not the right skill set. And, you know, technology is always changing. So, you know, if they're not training on all of the different new technologies, they might be a detriment. And so they might be on the bench a lot. So when you look at utilization and your utilization is low, and you have X amount of people, consultants delivering on these projects, if you increase your utilization, you don't need as many resources. And so that kind of aligns the costs. It's going to drive your gross profit. The bigger you grow, your costs are relatively fixed below the line. Your net income was going to naturally increase. So that's kind of how I look at it. And I think in order to appropriately cost your employees, you're going to need their salaries, any bonus incentives you plan on paying out. And I usually include what the entire opportunity is, not, okay, here's what we plan on paying them, because you really shouldn't determine that. And so throughout the year, you'll build up a bonus accrual. Now, if employee A, let's just say you're going to pay everybody 10%, for example. You have someone who is overperforming and another person who's not quite there yet. You have a pool of money, let's say. So you could reward, you know, that employee who's overperforming more than 10% and the other employee less. You know, let them know communication is key. Here's where you need to be. Here's what you want to be. And here's what we need you to do to get there. Also, it's a two-way conversation. What do you think you need to do? So also included in that is your benefits. And any other fringe benefits, so just not medical and health, and the employer paid taxes. So now you have the full cost of your employees. You know, you can go ahead and calculate their hourly rate based on 2,080 hours. But again, you have to factor in utilization. So by doing that, it's actually, if they're not 100% utilized, their cost is going to be higher, which should be taken into consideration when you are building out your statement of work and quoting your client on a price. And to something you said earlier as well is, well, what if the client, you know, they can't justify, you know, that cost? You need to prove that there's value there monetarily. Okay, so it's going to cost you this much, but if you follow this process and you can build out a model, I'm not saying it's the easiest thing to do, but you can build out a model that says, okay, here's all your resources, here's their roles. We can look at it by employee, or we can say, okay, here's utilization for this role, the average utilization. If we increased utilization by this much, you know, here's what it's going to add to gross profit.
Right.
And, you know, therefore, your cost is probably not going to be as much as they're going to make in additional revenue.
Well, you could argue, I mean, there's the old joke about, you know, you lose money on every sale, but you make it up in volume. And a lot of businesses kind of run that way, I guess, even with, they're getting prepayments, that's keeping them going. They're getting new sales coming. It's kind of like a Ponzi scheme in a way. It's very easy to get into this where the new sales are funding for the old bad projects. And you could argue that if you don't set that model in the first place, did you ever have a profitable business? I mean, if I were to do this, what I'm hearing is, like, let's say some rule of thumb here, like, so I have the fully loaded cost of the resource per hour, you know, including the utilization rate to give me a base there. It sounds to me that I need to be building them at 3 times that, because 25% is going to go to the sales team, maybe, and the marketing sales, 25-30% to the sales and marketing cost of acquiring that job. You leave 10% for incentives, like you're saying, and then that would get you to a 20% net margin on those projects. Are they typically the numbers you see?
It does vary. First of all, it can depend on the role, you know, because let's say directors, they have the responsibility of managing all these employees and making sure you're meeting your goals.
Sure.
And then you could add tiers all across the board too. Let's just say your gross margin is 30%. Well, okay, if we make 40%, then 10% is, that's what's going to be included in compensation. But if we make 45%, your bonus opportunity could be, 15%. And that's a pool, again, based on performance. I'll give you an example. So let's just look at one resource, and they're 60% utilized. They make $120,000 per year. So they're working 1,248 hours out of the possible 2,080 hours. Their hourly rate is going to be $96. That's the cost to the company. And then if we increase that amount to 75% utilization, they cost $77 per hour. So you can kind of see that you're going to make more profit if utilization is higher. So if we take that on an annual basis at 60% utilized, we'll make a gross profit of 112, versus if we increase that to 75%, we'll make 152,000. So there's a 40,000 delta right there. Those are funds you can add to your bonus pool. So it's a win-win for everybody on the team.
Right.
You don't have those consultants having the perception that this company just wants them to work more and more and more, push them harder, and what's in it for them, and that's where you'll see everybody's rowing the same direction. And it's got to be communicated, I'm not a fan of sharing full financials at all. But so if I'm a consultant and I'm responsible for gross margin, because that's based on my performance, how quickly I can deliver a project, and they don't really need to see anything else. They need to see that metric that is basically that they can control.
I get that you don't like sharing the financials. I'm just curious, is that a gut feel or have you seen it gone wrong?
I've seen companies, startups, where they do share full financials, and then all of a sudden their business takes off. So they're making a lot on their bottom line. And there might be some employees who have that perception, okay, I should be making more money. You guys are making more money. Why aren't I making more money? Maybe you can pay them more than a market rate. But again, I think market rate is a good approach. It's the bonus plan that's really going to incentivize them to say, hey, I can make 10%, I can make 15%, and depending on your role, maybe you can make 25% bonus.
I guess there's a bit of psychology at play there. You're giving people an opportunity. Do you want to earn more money? Okay, I'm giving you a way to do it. Like, here's a way you can do it. Go at them, champ. I'm very torn about this because, of course, I've been an employee most of my life or whatever. And then, as we've grown, we hit these problems as well. Rich and I do unreasonably well compared to everyone else in terms of what the business does. And that feels very wrong sometimes. It just feels wrong, even if someone is on the right side of that equation, if you like, So I'm interested in these models of putting incentives in, but I'm always very nervous of it because I've seen incentives go wrong. Like I've seen it where you're incentivizing things and you're driving the activity, but not necessarily the outcome you're looking for. And I guess what I'm getting from listening to you is if you're properly accruing for your costs and your value delivered, then that's how it aligns everything to, okay, the client's getting what they paid for. Therefore, you can know for a fact that, okay, you are actually delivering, you're delivering to the bottom line at the end of the day. And that's what you can comp on. You're trying to bring everything back to that financial model rather than whatever, phone calls made or lines of code written or whatever.
And it's a teaching moment too, involving the CFO, controller, potentially the CEO, and maybe directors and below. Just, you don't have to share salaries. You could just say, here's the cost to deliver. But they truly need to understand how financial statements work. They really do. It's a training. They're more involved and more engaged and more committed to doing what you want them to do if they understand financial statements. So that's what I've experienced anyways. They get excited about it because, again, I think most of us who really are passionate about what we do, we want to surpass and exceed expectations.
100%. That's kind of the irony is delivering value, being of service to people, I think is what gives satisfaction. ensure the money is a thing. And there's a lot of ego and everything built up in the money, and a lot of, societal value put in it, et cetera, et cetera. But it's ultimately not a sort of happiness. I don't know. If you're listening to this podcast, you're definitely in, the top one, probably in the top 1% in the world in terms of where you're at. And, we should be grateful for that, I guess, especially if you're working for me and you're worried that So this has been fun. I've really enjoyed it. Listen, I've heard many times people talk about accrual accounting, but I've never managed to join the dots before about how it can be used to align incentives within the company in that way, especially on the value delivery side, which I really like. Thanks very much. I'd like to sort of a little bit wrap up. I know we had a lot of things to talk about, but I have a sort of a traditional question I'd like to ask people at the end of the podcast. But before I get to that, let me just ask, how can people get in touch with you, Justine, if they want to reach out, find out more?
Either, email me. My email address is Justine at Fit2Grow CFO.com. I have a website. You can either email me directly or you can put in an inquiry on the website, which will go directly to me. And I get back to people pretty quickly. I'm also on LinkedIn. You can find me. So those are the best ways to get a hold of me. Schedule a conversation. I don't charge to have an initial conversation at all. We just kind of have a conversation like this. That's how you can get a hold of me. I'd be happy to either give you some ideas if, you don't want to move forward with a whole project and recreate the wheel, or you can engage me and I could basically quickly put together, well, maybe not quickly, it depends how large your business is, but I could put together the model for you, which you can use for modeling different scenarios, as well as looking at it, again, setting that baseline from a historical perspective so you know where to set your metrics, let's say.
And we connected on LinkedIn. So you're very responsive on LinkedIn. I know that. So that's a good place to reach out. And hopefully people will understand the reason behind the model and why it's worth putting the effort into the model up front. If you are still listening to the podcast, thank you very much. If you're also passionate in an area of FP&A, accounting, finance, brokering, whatever, I'd love you to go onto the podcast and go deep with me on that topic. You can reach out to me at james.kennedy@procurementexpress.com or indeed on LinkedIn. But this has been a great one. I've really enjoyed it. Thank you very much, Justine.
Thank you, James. I appreciate it.